Hey, what's going on, team? It's Ricky with Tactful Solutions, and this question actually got asked in our Learn Plan Profit group. I thought it was a pretty good question, and I want to ask you guys, right? I don't think that there's a right or wrong question when it comes down to the idea of, what should you do, right? When you're just getting started, and this is what this video is about, when you're just getting started as a beginner trader, keyword, beginner trader, not beginner investor, does it make more sense to pay yourself every single time at the end of the month or whenever it is that you find that to be back to your beginning balance, or should you compound your money? And I'm here to simply share my opinion just like all of you guys. So make sure to share your opinion and in your experience what works best for you, because I think that we can both agree that, we're all in different positions. And if someone is okay with compounding their money because they truly don't need it, then that's an approach and that's a benefit that they have because of the position that they are in their life. When it comes down to someone that would benefit from maybe a couple $100s that they make of profit, right? And they pay themselves and they begin to trade again with that beginning balance, then I don't see anything wrong with that as well. So simply share your opinion in the comment section and make sure that you don't forget to drop a thumbs up if you think I earned it. So in my opinion, I think that if we're just getting started, we have this very core principle within Learn Plan Profit, right? And it's this idea that when you're just getting started as a beginner trader, you are trading to learn, not trading to profit, right? I think that there is a big learning curve when it comes down to day trading. And I have seen, based off of the tens of thousands of people, right? We run Tactful Solutions. We have over 233,000 members within our free Facebook group. And I have seen so many times that sometimes beginner traders can get lucky and they can begin to grow their account much quicker than they grow as traders. And let me know if you agree. But because of that, it really only takes a couple trades for things to really go south. And yes, you can be up 20 or 30% within either a couple of days or a couple of months of trading. And let's say you start off with $1,000 and you grow your account, 50%, right? Whatever the case may be, you grew your account 50% and you are just on top of the world, right? You're like, dude, I nearly doubled my account. I'm up 50%. I have this figured out. When things begin to go south, as they tend to do, right, within the market, let's say you are just not there as a trader and your risk management just is not at its prime. If things begin to go south, how quick can you give back all the profits that you made? How quick can that happen if you are not there as a day trader? And that's the simple idea that I'm here to share. I think it's great that if you're there as a trader and you want to compound your money, cool. If you don't want to take account size or overall position size or the overall influence that you can have on the overall market in the hundreds of thousands of dollars, even if that doesn't hold you back from paying yourself, right? When it comes down to just getting started, mistakes are going to be made. And the single most mistake that I see anyone makes within the market is their lack of risk management. And yes, you can be up 20 or 30% within a very short period of time, but it does not take long that if your risk management is not there, that you can give it all back. I do agree that, okay, well, if we stick down to the principles and the fundamentals of what every trader should trade by, there should be a form of risk management. And if they were able to grow their account 20 or 30%, they should know how to manage risk and to simply cut losses. Again, on paper, yes, I do agree. It is a completely different monster when it comes down to trading with $1,000 and that's your initial account size, to maybe then trading with $100,000. And let's say you manage your risk at 1%. I know these are big differences. But seeing a 1% loss at $1,000, hey, not too bad, $10. Seeing a 1% loss with $100,000 is $1,000. Just emotionally being able to see that number and what you just gave back, it's completely different. And I do agree that the core principles of risk management should be there. But I think that as you are simply just getting started as a beginner trader, you should be trading to learn, not trading to profit. Do you not agree that, as you're just getting started, you should be focusing on building experience, being more comfortable and becoming more comfortable with the overall market and what it is that you are trading? And yes, I do agree. But when it comes down to 5 or 10 years down the road, with the dollar amount that you are trading with right now as a beginner trader, is it the same amount that you can be trading with 5 or 10 years down the road? No way, right? Because if you get to that 5 or 10 year period, you're gonna have more experience, you're gonna be more confident, right? And you're gonna understand what it actually takes to grow your account as a trader because you have that tenure, right, in the market. You've been through it. And I just think that to get to that point, when you're just getting started with the simple idea of trading to learn and not trading to profit, paying yourself or taking out the dollar amount besides the principal balance of what you originally started with is not so bad of an idea. So paying yourself at the end of every single month, every other month, whatever the case may be, how it's not the worst idea. And again, that's just been in my experience where I've seen a lot of traders outgrow their trading counts based off of where they are as a trader themselves. And I think it's the worst when, you see a trader just so motivated, so empowered, and they've done so well when they first got started, and then they experience 2 or 3 red trades of things just going south. They're devastated. They don't have the proper fundamentals when it comes down to risk management because they, experienced it for the first time. And they not only give back all the profits that they made, right? But they give back maybe a little bit more from their original balance. And it hurts, right? There's no question to put it, right? This market is not easy. I think that we can all agree that nothing worth having should come easy. But I think it takes a lot of growth. It takes a lot of experience. And it takes a lot of confidence to get to a point to actually trade with $100,000. And I think that experience, confidence comes at a much slower pace in comparison to how someone can actually grow their trading account. So that is why I think it's so important when someone is simply just getting started that sticking to the principal balance because that is what you agreed that you are okay with trading with, right? And then you can scale from there once you feel ready. So it doesn't mean that you have to compound your money as time goes on and you never pay yourself, but it doesn't hurt to taste the fruits of what it is that you have made. And on top of that, you can scale as you are ready. So if you first want to trade with, $1,000 and until you get to a certain point or a certain experience, and then maybe trade with $2,000 and then $5,000 and then $10,000, and you control the pace in which your position size grow in comparison to going at the pace that your trading account grows. It's just a simple idea that I wanted to share. It made sense to me. Let me know in the comment section what you guys think. Again, I don't find there to be a right or wrong answer. I simply think that it has a lot to do with the position in which where you are in life and what you are okay with risking. I do agree with the very principle that compounding your money, especially when it comes down to the overall idea of investing, same thing like I do with my rental properties or my real estate investment properties, compounding that money and then taking the overall profits, reinvesting the principal and the profits to get something much greater. Yes, it does make sense, but again, we're not investing in real estate, we're day trading in the stock market, which comes at a higher form of risk with, of course, a higher form of reward. So guys, I really hope that you guys enjoyed this video. If you guys did, we'd really appreciate the thumbs up if you think we earned it. And again, don't forget to join our free Facebook group. That's gonna be that first link down below. Like always, guys, let's make sure that we end the year on a green note. Take it easy, team.